Last year, you wrote a check for $200,000 or more. Painful, right? Were you okay with that? Because I can show you 5 moves that could cut that amount by at least $125,000. If you're earning between $1 million and $10 million a year, there are 3 types of people when it comes to tax. The first type pays whatever the IRS says and complains in April. The second type scrambles in December. By then, most of the windows are closed. The third type plans year-round. They implement tax strategies before the taxable event happens. And every year, they keep significantly more than people who aren't planning. Everything I'm about to show you is what I actually implement with my clients. I am Miguel Palma, CPA, with over 30 years as a tax strategist, trained at Deloitte PwC and PwC. Strategy 1, stack and optimize retirement. The $250,000 annual deduction. Most CPAs set up a 401k and call it a day. That is a $72,000 deduction in 2026. For someone earning $3 million, that barely moves the needle. A solo 401k gives you $72,000. The real move is stacking retirement vehicles. A solo 401k gives you $72,000. A cash balance plan, which is a defined benefit plan, often called a hybrid, 1,000 deduction, depending on your income and age, gives you another $100,000 to $300,000 deduction, depending on your age and income. Every dollar is a direct deduction. Stack them together, you're looking at $250,000 or more on retirement-based deductions per year. At a 37% bracket, $250,000 in deductions saves you $92,500 in tax every single year. The 401k is the starting point, not the strategy. If nobody ever talked to you about stacking, you're leaving over 6 figures on the table. Strategy 2, appreciated asset donation, twice the benefit. Most people donate cash and take the deduction. There is a better one. If you hold appreciated stock bought at $10 worth $100 today and you sell it, you pay capital gains on the $90 gain. Donate the asset, but if you donate the stock to a charity or a DAF, you get the deduction based on the full $100 value. You avoid the tax on gains and you get the full deduction, double benefit. This works with stock, appreciated art, real estate, and business interest. Non-cash donations over $5,000 require an appraisal. And if you use a donor advised fund, you get the full deduction the year you make the deposit. Then distribute the donations over time. For anyone with a big liquidity event, this is a precision tool. Strategy 3, Augusta rule in hiring your children. Under IRC Section 288, if you rent your home to your business for 14 days or less per year, the rental income you receive is completely tax-free to you. Business deducts it as a legitimate business expense. Board meetings, planning sessions, strategic team event, each day counts. A fair market rate supported by comparables and a legitimate business purpose. Move 2, hiring your children. If your children actually work in your business, you pay them a reasonable wage for real work. In 2026, if they earn under $16,100, that income is effectively tax-free because of the standard deduction in 2026. And the beauty of it is that it's deductible for your business, for sole proprietorship and Medicare tax. Remember, real work, real compensation, documented hours. This isn't a paper transaction. It has to be documented. Strategy 4, entity structure. The 30,000 to 80,000 tax mistake. If you're operating as a sole proprietorship or single member LLC, every dollar of net profit gets hit with self-employment tax. That is 12.4% Social Security on the first $84,500. Then 2.9% Medicare on anything above that, plus 0.9% Medicare tax on anything above $200,000. An S Corp splits your income into a salary and distribution. Self-employment tax applies to the salary only. On $1.8 million in profit, we have seen the gap exceed $80,000 per year. Same income, different structure. Strategy 5, real estate and cost segregation. Real estate has tax advantages that don't exist in other asset classes. When you own investment property, the IRS lets you deduct depreciation, a non-cash expense that reduces your reported income without costing you a dollar. Standard depreciation is the slow lane. Cost segregation is the fast lane. 5 strategies: retirement stacking, appreciated asset donations, Augusta rule and family employment, entity structure, real estate and cost segregation. None of these are gray areas. They're actually in the tax code. They're tools that the Internal Revenue Code provides for business owners and investors that are structured correctly and planned before December 31st. On average, my clients discover that they have been overpaying $125,000 per year. That number comes from planning, quarterly conversations, emails, and a cadence of properly planned meetings. Catching opportunities before the window closes, or catching mistakes before you make them. If you're earning between $1 million and $10 million, I am offering a free tax strategy assessment. No BS, your actual numbers. Click the link in the description. 2 minutes, spots are limited, and remember, you'll walk away with clarity. You got this.